Good morning, everyone. We're going to start in 1 minute. Good morning, everyone. Thank you for joining us at today's webinar. My name is Marzia Zafar, and I'm the Director of Innovation and Issues Monitor here at the World Energy Council. I will be the moderator for this webinar. I'm here in London with my colleague, Pauline Blanc, Manager for our innovation work. And we are joined by 4 guest experts, all interviewees of our latest brief on existing energy infrastructure. Michael Weber, CTO at Engie, Dave Hardie, Director of Liability for Alberta Energy Regulator, Hassen Bali, founder of Ion Ventures, Jacqueline Vaessen, General Manager for NexStep. So let me quickly go over how we'll run this 50-minute session, and then I'll turn it over back to you for questions. We will start with a 2-minute overview of the key findings of our latest Innovation Insights brief. We will then open the floor to hear your questions. This is your opportunity to ask our experts any questions you have on the subject. So the bulk of the webinar is for you to ask questions. You can submit your questions via the question function. You can either tell us if you want to be named or remain anonymous. We will read the question aloud and direct it to one of our guest speakers. If you would like to share a comment, please do the same. Use the question function and identify if you want to be named or not. First, to get a sense of where everyone stands, I would like to ask everyone on the webinar a starter question. This will pop up on your screen. Please choose the option that best fits your perspective. The question is, where do you see the biggest repurposing opportunities? Is it gas pipelines, A, or is it oil fields for CCS, B, or is it offshore oil platforms, or is it that stranded assets and our decommissioning are more likely scenarios, or E, you don't see repurposing as an opportunity? I'll give you about 10-15 seconds to choose one of those multiple choice answers, sorry. Okay, thank you so much. And we're gonna put everything on YouTube afterwards. All the responses, and we'll ask a question after the fact as well. So before I open it up for questions, let me tell you briefly why the council selected this topic and also what we found. We looked at existing infrastructure because decarbonization and energy transition seem to solely focus on greening the supply of energy. We also received a very persuasive and persistent advocacy from Dave Hardie, who is also one of our experts on the call taking your questions. And we conducted exploratory interviews as a result from all corners of the world, ranging from Canada to Saudi Arabia to Europe and Asia as well. The key findings from these interviews were 4 things. 1, existing energy infrastructure is an afterthought to decarbonization, yet a successful energy transition depends on infrastructure that is adaptable, reliable, and affordable. 2, use of existing infrastructure as a resource for more affordable transition to decarbonization. And realizing this opportunity must be a priority that requires consideration of infrastructure repurposing opportunities where they make sense. 3, the magnitude of stranded assets are unknown to the market. There's a potential risk that decarbonization could become cost prohibitive if large portions of existing infrastructure are stranded. And finally, 4, businesses should reframe market strategies to explore the opportunities for reusing existing infrastructure to support transition to a low carbon future. As a result of these interviews and these findings, which the overwhelming majority of them encourage a government-led vision, the Council has developed a set of principles for designing an infrastructure action plan to ensure that decommissioning stranded assets and or repurposing does not become a barrier to affordable decarbonization. So the idea of an action plan is nothing new, but actually doing it is the issue. We know of only one country who has taken this initiative in an organized fashion, and that's the Netherlands. And in our report, we have highlighted NexStep's action plan as well as California's energy action plan. And Jacqueline, the General Manager for NexStep, is here on the call to take your questions. I will now stop talking and open up the session to your questions. Please submit your questions via the question function, letting us know if you would like to ask, if you'd like to be anonymous or not. We also received a few questions over the weekend, so I'm going to go ahead and ask one of those questions now, and this is to Michael Weber at Engie. The question is, as an owner of existing infrastructure, how is Engie dealing with the transition to decarbonization, knowing that some of its assets will no longer be needed?
So that's a great question. Thank you for that. That's on my mind a lot. So this is Michael Weber, as you heard, Chief Science and Technology Officer at Engie. I run the research program at Engie, which means we think about research solutions to some of our problems. I don't control the assets, but I sit side by side with the people who control the assets. We have a lot of natural gas assets at Engie, a lot of natural gas power plants, and a lot of natural gas pipelines and storage capabilities. And finding a way to utilize those assets is on our mind. And a question we think about is whether we need to replace those assets for greener options, green hydrogen, for example, or can we leverage those assets? So right now we're trying to leverage those assets by injecting hydrogen into the pipes. And we've done some really good research and demonstrations with our GRID project, an acronym for our green hydrogen injection project, where we can inject hydrogen up to 20% by volume in our pipes, which is a good news story that we can leverage our existing assets for hydrogen transportation. The bad news is 20% by volume is 6% by energy, and so that's a limitation for us. And we're not clear that we can go to 100% in those same pipelines. So we might need to rebuild or replace those pipelines, which sounds very expensive and would create more costs for the system. Another way to leverage the assets is to use the hydrogen to make methane, green methane, a synthesized methane, and then we can use the same pipes and power plants. So that's a fundamental question on our minds, is whether it's cheaper and easier to replace the gas in the infrastructure or to replace the infrastructure. And right now we're looking at both, and we hope to have the answer soon. And I think the question on our mind about that is probably the same as the question on a lot of people's minds around the world who own natural gas infrastructure. So that's the way I think about it from the research perspective.
Thank you very much, Michael. This is Pauline here, and I work very closely with Marzia. We've been working on the topic of hydrogen. And I was wondering if you can tell us a little bit about the timeline that Engie has in mind regarding all these projects and regarding hydrogen specifically.
Yeah, so there's a variety of timelines. We have a very aggressive timeline, a 3-year timeline within the company to increase our production and capacity of renewables, to build 9 gigawatts of renewables in the next 3 years. In fact, we've almost announced all the renewables we need for that. We have about 8.5 gigawatts of the 9 gigawatts already installed. That is relevant to hydrogen because if we have more clean electricity available at an affordable price, then it opens up the pathway for electrolysis for hydrogen. So we have one very near-term pathway for renewable electricity. In addition, we have longer-term pathways about decarbonizing aggressively by 2050 to match some of the international and other global standards and expectations, which also means that we think hydrogen needs to be a big answer by a few decades from now. So there's an immediate timeline at Engie around cleaning up our electricity mix, which we've been doing for years by selling coal plants and building renewables, but keep that going very aggressively for the next 3 years. And by the way, the renewables are a big part of our profit margin, so we like renewables because they're clean and they're affordable and they're profitable. In addition, a longer timeline for hydrogen because the system is more complex and has more nuance, as your as the report from WEC notes. And so that is a longer timeline that will unfold over decades. And we still don't know whether it's going to be a hydrogen infrastructure or whether it's going to be hydrogen on the way to something else, ammonia, methanol, formic acid, methane, that kind of thing, and then an infrastructure for that. So we have a much slower timeline for hydrogen because that ambition is much bigger.
Okay, thank you so much, Michael. The next question is for Jacqueline. Why would the Netherlands take this extraordinary step to set up a separate organization to deal with repurposing? And secondary to that is the person asked, I have also not heard of this organization. Can you briefly explain? Jacqueline.
Sorry, I just lost connection. So after Michael's answer, I didn't hear anything anymore. I just got in again.
Oh, sure. Sure. So the question to you is, why would the Netherlands take this extraordinary step to set up a separate organization to deal with repurposing? And also, if you could briefly explain the organization itself.
Okay. NexStep was established by NOGEPA, which is the branch organization for the oil and gas industry, and EBN, Energiebedrijf Nederland. They are the owners of the oil and gas infrastructure in the Netherlands. 2 years ago, in the end of 2016, a master plan for decommissioning was launched. And there it was the decommissioning estimate liability in the Netherlands is 7 billion euros. And NexStep was erected to you say that develop communication and working together in the industry to reduce the decommissioning estimate from 7 to 5 billion euros. But was also said during the launch of NexStep that there would be a great opportunity in reusing some of the existing infrastructure in enhancing the energy transition, and there we're looking at storage of CO2 and depleted gas fields. We're looking at electrification of platforms, which could reduce CO2 emissions by 1 million tons of CO2 per year. We're looking at production of hydrogen. Actually, we just launched a pilot, which we're going to do in 2020, placing a 1 megawatt electrolyzer on an existing and still producing oil platform. And we're looking at reusing onshore locations for geothermal energy and for production of green energy. And reusing infrastructure for CO2 storage and hydrogen production would also mean that we could reuse part of, well, a large part of the existing pipelines.
Okay, thank you so much, Jacqueline. Dave, I think this question is for you. It's online, and the question is, how is the cost of stranded asset, how is it covered, i.e. how much is it covered by government and how much is it left to companies, and how to define efficiently the proportions?
Yeah, great question. So the cost of stranded assets, it really depends on the region. As we've stipulated in our brief, the regional approach to this is really the critical foundation. So cost of stranded assets for what companies have invested, I'll take North America to begin with, what companies have invested in infrastructure, they certainly do it from a long-term plan. They anticipate what the market will be, they'll anticipate how much investment they have to put in for construction and for operations, and then for decommissioning. And when it comes to the cost of stranding those assets, it depends on whether it's a policy decision or necessarily infrastructure coming to a conclusion in terms of its structural capabilities, or if it's for other means. But the cost of stranded assets means the amount of infrastructure and the amount of money that has been invested that they may not recover later. So who owns it, whether it's government or industry, it depends on a number of things. If it's a policy decision that government says, for example, coal, that they're going to step away from coal for electrical generation, the question starts to arise as to whether there is, sorry, I'm here getting a lot of background noise. Is somebody else not on mute? Thanks. It depends if it's a policy decision to say that they're going to get away from coal electrical generation. Their question starts to arise as to whether it's a government sharing ownership over the cost of stranded assets or not. And in the event it's an actual investment decision in infrastructure, and the companies have elected to decide to strand the infrastructure because either resources are being depleted, if it's, for example, oil or hydrocarbon, or if it's another reason, it could be because the companies or individual industry.
Okay, thank you, Dave. I think the next question is, if Hassan, if you could respond, and Michael, if you could follow that up. The question is the investment community actively putting money into fossil fuel infrastructure?
Hi, good morning, everyone. Hassen here from Ion Ventures. So I think from what we've seen, increasingly there is a clear shift away from direct investment into the fossil fuel industry per se. Most people have adopted certain principles of investment, which are to slowly at least diversify away from fossil fuels and to largely concentrate on renewable forms of energy. I don't think that means that the entirety of the finance industry has made that shift as yet, but I think that the economics of investing in renewable energy particularly are now quite compelling. The continual decrease in the levelized cost of electricity generated from offshore wind, particularly onshore wind, solar, is actually compelling. The addition of energy storage technologies, particularly energy storage through battery and lithium-ion batteries in particular, the cost reduction there has been very significant in the last 3 to 4 years particularly. That's a direct consequence of the proliferation of electric vehicles as well, and the growth in supply chain, particularly out of China. So all of these factors, I think, offer a strong alternative to the traditional fossil fuel investment community, and I think that has diverted considerable amount of investment away. The challenge, though, I think with all of it is what's the long-term income stream that can be attributed to a particular investment. And I think this is where renewable energy has, for quite a long period of time, relied on a level of state subsidy, but is now reaching a period where it can stand on its own 2 feet, that the investment case over the sort of 25 to 30 year time frame demonstrates a good return on investment. You can start to attract different types of lower risk investors, particularly pension funds and the like, and consequently the opportunity is recognized amongst the investment community. And I think all of that is accelerating the transition away from fossil fuel investment, but I think it's fair to say that some continues, but there does seem to be quite a stigma attached to it now, particularly if you look at what the London Stock Exchange did in the last few weeks, which was to essentially rebrand its descriptor for all fossil fuel industry companies listed on the London Stock Exchange and describing them as non-renewable, and all of the renewable sector to now be very clearly described as renewable energy as opposed to alternative energy. And I think that in terms of taxonomy is just another step change towards making it almost more than just unpalatable for investment to continue in fossil fuels.
Yeah, good info. Michael, did you have anything to add to this?
Yeah, I have two perspectives. I have the Engie French perspective, and I also have the Texan perspective because I'm from Texas. And the Engie perspective is we've been changing our investment strategy for years. Very publicly, we've been selling off coal assets. We sold off our oil and gas exploration and production assets. We've changed our role in the liquefied natural gas industry. So we have changed our investment decisions for fossil fuels, absolutely. And we're not the only company doing that. And so we see that trend around the world. At the same time, I have this Texas view, which is West Texas and the Permian Basin is one of the hottest hotspots in the world for oil and gas production. And there's a lot of investment going in for oil and gas production there for a variety of technical and legal and regulatory reasons. It's a very easy and cheap place to produce oil and gas, and there's a lot of investment flowing in. So I'd say the investment certainly hasn't ended for oil and gas, although because of the things that were just mentioned about the London Stock Exchange, and also impatience among investors who aren't getting the returns on oil and gas like they thought, divestment movements happening in college campuses around the world. There's a little less of money available for oil and gas investments, even in a place like West Texas. So there's starting to be some slowdown by the investors and the shareholders who have pumped money into shale gas production for a decade, for example, who are starting to get antsy about not getting the returns. It's getting harder to raise the money for some of that production. The returns are lower. So we're seeing some headwinds even in a place like West Texas, despite the boom the last decade. I don't think that investments will certainly end. Large oil and gas companies are announcing multi-billion-dollar CapEx budgets for exploration and production, but it does seem like there's shifting allocations, and major oil and gas companies like Shell have announced that they're going really hard into electricity, or new energies, including hydrogen. So there's definitely some dynamics and shifts around. Feels like headwinds for the fossil fuel world to get the money they need, but it's not zero yet for sure.
Thank you. The next question is from, I don't want to butcher this name with my American accent, so I'm going to have my French colleague mention and ask the question.
Okay, so this is a question from Patrice Geoffron, and the question is, do we have any idea of the decommissioning costs of thermal power plants?
So I think Michael or Dave, if you, or Jacqueline, if you guys want to take that on.
Sure. So I'll make a comment I've got one small data point and then some bigger data points. It depends on what thermal and what size. It does scale with size, the decommissioning costs. Nuclear power plants are very large and therefore have larger decommissioning costs. Plus, they have special issues with the fuels and the waste, so that makes it more expensive. However, at least in the United States, I'm not sure in Europe, nuclear is one of the few power plants that builds decommissioning cost into its planning. Not fully. They build in the waste handling costs. So with every kilowatt hour for many decades, there was a surcharge to collect money for waste handling, including disposal and storage. The rest of the decommissioning costs for dismantling the power plant was not included. For nuclear power plants, which cost billions to build, decommissioning is probably a couple $100 million, something like that. So that's one data point. And oftentimes these costs are not built into the rate yet, and so they might not be something that have been paid for already, which means it's a looming cost or liability for companies depending on where they are in their asset mix. One other data point from Austin, Texas. I was an electric utility commissioner there for 5 years, so I was like a regulator for the municipal utility. This is $1 billion plus utility with about 3 gigawatts of capacity, and they're shifting the fuel mix from carbon intensive to less carbon intensive fuel mix to meet the desires of Austin, a very clean town. And one of those power plants to shut down was about a 50 to 100 megawatt power plant in Austin because it was in a neighborhood and the pollution was affecting the local citizens, even though it was at one point a fuel oil plant, but then a natural gas plant. Dismantling that plant, which was a pretty small natural gas plant, still cost about $40 million to dismantle that. To build it new would have cost maybe $200 million, something like that today. So it can be pretty pricey. That was more expensive because it was in a neighborhood. It was harder to get access with the trucks and that kind of thing. But it's a big cost. And I think that goes back to the stranded asset comments maybe 10 minutes ago. Stranded assets are not just the pipelines we have to worry about, but these power plants that if they live their useful life will be expensive to take down. If they are shut down early, 20 years before the end of the useful life, they will still cost money to shut down, but they will have generated less cash flow and profit along the way, and that's a cost that will be borne by society in one way or another, something to think about.
Dave or Jacqueline, did you guys want to add to that, or should I move to the next question?
Well, I don't know anything about thermal power plants. We are only looking at the oil and gas infrastructure, so I can add nothing to this.
Okay. So
I can just add briefly that the costs are super variable depending on the size, location, and immediacy of needing to deal with it. And all of those things, because of lack of planning, which I see across North America, is one of the biggest challenges. And the costs are usually substantively bigger than that were originally planned for. The costs for some of the plants that have happened in North America were usually 3 to 5 times more than the original planned value.
Jacqueline, this question is directed to you. As a person who leads one of the very few national organizations that have been tasked with developing and delivering on a plan to address this challenge, how critical has the decision to form NexStep been for the energy future of the Netherlands?
So what do you ask? What next step? The last question or the last sentence I didn't hear.
How critical is NexStep for the energy future of the Netherlands?
Well, I don't think NexStep is critical for the energy future of the Netherlands. It will prove value to the energy transition, but I wouldn't go on that big shoes that it's critical for that. We're looking at repurposing infrastructure for the energy transition, but our main task is to reduce decommissioning costs by 30%, and which will lead to a big saving for the Dutch taxpayer, because the government ends up paying 70% of decommissioning costs.
And do you,
And what we can reuse, we don't have to decommission yet. And in the end, we will have to dismantle everything, but hopefully, and we're also working on an innovation agenda, and we hope that we can reduce cost of decommissioning project by finding innovative ways.
since you've been, since NexStep has been organized, is there a number that people can associate with savings, or no? Or not, is it too early?
Well, we're the only existing. I started 1st of February 2018, so we're only busy over a year. But we are working on a joint campaign, which could on midline suspensions, which are wells which have been drilled for exploration but never became into a production well. We're looking at a project of doing that jointly within the industry, and that could lead up to a saving of 200 million euros.
Okay.
We're also looking at, well, we're going to do a trial with offshore hydrogen production. And in the Netherlands is quite far in developing its first offshore CCS project, which is named Portos. It's around the port of Rotterdam, and it will collect the CO2 from the industry in the Rotterdam area and will transport it to a depleted gas field.
Okay. I actually would like to know more about that, so I'm going to keep connected with you to make sure I know about the CCS plant. The next question is for Hassan. How is the cost of transition affected by the effectiveness of the planning and supporting policy?
Well, I think that so far most of this has not really been factored in according to a sort of predetermined planning approach. So clearly, whenever you build a new power generation facility, and my experience is heavily weighed towards renewables, you have quite a lot of planning hurdles that you have to overcome to ensure that you're complying with regulations, but obviously ensuring that you have a plan for decommissioning. So interestingly, where it seems that the majority of the thermal generation industry, apart from nuclear, has not necessarily factored in or had an obligation to factor in all of its decommissioning processes. And I think this is largely because they're expected to last sort of 50 to 70 years. And the UK is a case in point, because lots of the thermal generation has actually gone way beyond its intended end of life and has been sort of upgraded and refurbished to continue. What we've noticed is that with renewables, there's a clear mandate to decommission, and that's already factored in. But none of that really sits within a cohesive overall policy plan to look at how does that particular piece of generation infrastructure sort of tessellate with the remaining infrastructure that's in place. So if you think about the gas network, for example, there's nothing that looks at the proximity of a gas network to where you might be building a new renewable energy facility. And actually that's probably an opportunity, because if you were to align those sort of metrics, you might find that if you made it a condition of permission to construct, that there was the ability to generate using any surplus solar or wind or any form of generation to produce a byproduct such as either hydrogen or synthesized methane or something like that, you might find that you could dovetail that with the gas infrastructure and then have a co-benefit of extending the useful life of the existing gas asset by repurposing it in the way that Michael mentioned earlier. However, that isn't really part of the planning structure as we see it today. So I do think that there is a significant oversight there. There's an opportunity for more strategic thinking and alignment of how to essentially overlay new infrastructure with existing infrastructure, and to identify clear opportunities where you can benefit on both sides by being having more foresight in how you develop and integrate those different infrastructure levels. But as I say, today we're not seeing anything that's really cohesive or particularly forward-looking. It's very much a case of saying, I would like to build a particular asset on its own 2 feet. It has an investment case and a long-term operational benefit, and then it gets constructed. And if it does have a decommissioning aspect at the end of it now, but there's no obligation to link in with existing infrastructure.
Okay, thank you. We have a couple more questions online. I have a question of my own, and I want to ask all 4 speakers, and if we could just go in order. So Michael, Jacqueline, Hassan, and Dave, that would be great. My question is this. You know, during this interview process, we received overwhelmingly the response that government should step in with a vision or with an action plan or to push the market forward. And I'm wondering why, because why does the market need government to step in? Because the governments have already stepped in saying that, you know, we want decarbonization to combat climate change. They've set up a vision through the UN. They've set up their own individual visions. Why does the market need government to step in at this level when I feel like they've already done their job? Because in a way where the market is always saying, government stay away, let us do this, and then now we get the response as, why isn't government stepping in and giving us a vision? I don't know if I asked that question eloquently, but I'm just wondering why does government need to step in?
So this is Michael's voice. I've got 2 responses to that. I think it's a great question. I want to build on the last comments. I think the government needs to step in for 2 reasons. One is the rhetoric from the governments and through the UN and the international accords is very useful, but fundamentally there's a market failing, and that the market does not have a price on pollution. And so the market needs to internalize or incorporate this price, and that means government intervention to use the markets to put a price on pollution. There's a regional price on pollution in the northeastern United States and Europe and different places, so there's some regional prices, but there really isn't a price comprehensively, coherently, or consistently around the world, and that's a problem, and that confuses the investment signals, the price signals, the market decisions, the capital allocation, everything. So that's why you need to have government interventions, because the markets aren't doing this on their own. A second reason why I think we need better policy or smarter policy design is because one of the real killers for the energy industry is policy volatility. We think often about price volatility of the fuels or the commodities or steel or cement or natural gas or whatever it is, but policy volatility, which is policy that changes quickly from era to era, from different president to president or different legislature to legislature, is really creating whiplash for the industry, because the industry is making decisions around assets that will last 25 to 60 years, depending on whether it's a wind turbine or a nuclear power plant. And if the policies change every 2 years over this multi-decade time frame, excuse me, it really complicates the decision-making process. So not only does government need to intervene to fix this market externality of pollution without a price, it also needs to intervene to create consistency of policy to avoid the policy volatility, to streamline the decision making. Right now, a lot of decisions are just on hold because we don't know what the policies will be. And so those are my 2 quick responses on that question. Great question.
Thank you. Jacqueline, did you want to add something?
Yeah, I got kicked out again, so I missed the question, but based on what the previous speaker was saying, I can add to that. We see the same in the Netherlands, that we had a process called the Klimaatakkoord, which was a big group of all kinds of organizations, industry, NGOs, government, and it took till end of last month before that the results came, and that led to a lot of well, there was no movement until the results of this climate accord were known, and so we did not make many progress in the past year.
Okay, thank you. Hassan?
Yeah, I think a really interesting question and very multifaceted to try and respond to. But I think a couple of takeaways from my point of view. I agree that the policy volatility that Michael mentioned is very present and is problematic, and that's not just in sort of areas, say for example, sort of Western Europe and the US, where there's already a consistent push towards additional renewables and a slow glide path to remove thermal generation. I think it's particularly problematic in areas where there are vast numbers of people who have no or very limited access to electricity. And if you look at sort of that electrification requirement across Southeast Asia, Sub-Saharan Africa and parts of South America, the lack of policy cohesion is actually stymieing not just the shift away from fossil fuel generation, but is actually stymieing the access to electricity full stop. And I think that, a cohesive approach where there is a level of consistent policy as part of local strategic planning, but also to integrate with a much more international mechanism, particularly around pricing pollution, I think is really important. And whilst market mechanisms are really, they can be very effective when mobilized appropriately, they are all seeking to make a return. And I think that's the hard part, is when you are comparing different approaches and technologies and solutions, and the most profitable, lowest cost option is the one that the market will inevitably choose. And I think there is a requirement to add a little bit more guidance to not just always choose the cheapest, but to choose the one that has the total cost included, which is where I think the cost of pollution is really important. And I think the one other element that we're seeing a large increase in at the moment is this concept of social license to operate. And the political cycle for various governments in various parts of the world is also inherently linked to the voting populace. And there are certain topics which are now reaching a level of prominence and I think importance for people internationally, that they are slowly adding pressure to their respective political systems to respond in a way that starts to factor this in. And I think that the two strongest case in point at the moment are air pollution and plastics pollution. And if you look at the way in which the knowledge and the awareness of those two issues has increased significantly in the last sort of 3 to 5 years alone, the impact that's having on political systems to try and incorporate ways of addressing those concerns in order to maintain their position in power, I think will slowly start to translate down. But I do think that aligned with market mechanisms is a really important step that needs to be worked on. And with luck, we can get some strong policy in place that gives the right guidance and lets the market deliver the rest.
And Dave, did you want to round it out?
Sure. So I think the answers so far have been really good and comprehensive. The one piece I would say is that there is an inherent fallacy that the market is as efficient as it can be. It will develop as it needs to. And the point of having a successful transition with policy and vision set by the government is to assist where the market isn't moving as fast as it may need to act as a vehicle to bring the parties together to have coordinated discussions, sharing lessons learned, sharing information, etc. That's a critical piece for a government and critical discussion that needs to happen right now.
Thank you very much. Michael, I think we have a question for you. This is a question from Randolph Brazier. And I think what he's talking about is about hydrogen. And he's asking whether if we build the infrastructure now, will demand follow? For example, building a hydrogen-ready grid should entice hydrogen players to come along. And what he's mentioning is that infrastructure, or the lack of it, is often seen as a make-it failure. So what if we change the game and actually build the infrastructure ahead to spur the market forward? What are your thoughts on this?
That's a great question, and my answer is yes, but no. So let me explain the yes, which is I'm very pro-infrastructure. Generally, I believe if you build the infrastructure, people will use it, and this is true for telecommunications, railways, roads, power plants, you name it. And Again, going to the Texas experience, we built the power line infrastructure to enable renewables, and then renewables really boomed. It's just, there are many examples where you can build infrastructure, and it really facilitates the incorporation of new forms of energy into the market. And if you do not build the infrastructure, it inhibits the adoption of that particular fuel technology. So in the United States, where we do build power lines, we get more renewables. Where we do not build power lines, the renewable growth slows down. That's especially true for oil and gas pipelines. If you don't build the gas pipelines, you cannot move the gas, so we have problems with flaring and that kind of thing. So it is important to build the infrastructure, and I think often you should lead with the infrastructure to enable this. However, it is also possible to build the wrong thing. You build a very expensive infrastructure that will last decades, but you build it for the wrong thing or pointed the wrong direction, and it sits unused and idle because you guessed the future wrong. And for that, let me give the example in the United States of liquefied natural gas import terminals. Every analyst about 15 to 20 years ago said we're running out of natural gas in the United States. We need to import more from the Middle East and Russia. We need to build liquefied natural gas LNG import terminals. We need to build them quickly. Let's build dozens along the East Coast and the West Coast. These cost billions of dollars a piece. And so we built a half dozen or so. We didn't build them all, just in time to have these import terminals ready to go right when we created a gas boom that created an export boom. So now we're trying to build export terminals as quickly as possible because we built the wrong thing in the wrong place, pointed the wrong direction. And they sit idle, and that's very expensive. They can be repurposed for export, but that costs $1 billion on top of the $3 billion you already spent to make it an import terminal. So I tend to be pro-infrastructure, and I think if you build it, they will come. Except sometimes we have examples where you build the wrong thing and they don't come because the markets switch direction. And so that's something you have to be mindful of when making big decisions on infrastructure.
Thank you so much for that. And just because hydrogen is such a big topic at the moment, what will be your recommendation to a country, a company who is looking to join the hydrogen discussion, to join what's happening right now, and how do we approach the challenge of infrastructure?
Is that question for everybody or from me?
Start, and then maybe if anyone has any other inputs.
I think the theme you heard earlier, and then I'll get out of the way so others can comment, is regional specificity. Like, you have to be region specific because the needs in Japan, an island nation that doesn't have fossil fuel production and they don't have that much sunshine, for example, will be very different, and therefore their infrastructure will be different than a country like France, which has a lot more land area per person. And so you have to have regional fidelity and customization to really get there. And so it's better to start with what the local needs and capabilities are, and then you figure out the infrastructure solution for there.
Okay. Hassan, anything to add to that?
I think, yeah, that covers most of it from my point of view. But I suppose the one element to add is that as we start to move towards a period of time where with luck we have a predominant dependency on renewable generation for our electricity, the need for flexibility becomes paramount, and that flexibility will be served by varying technologies. A lot of that will be around means of storing energy, and hydrogen is a very good potential means of storing energy, in that, you know, whenever there are the peaks and troughs of renewable generation, you can obviously utilize the hydrogen to have a slightly larger mass of energy that you can hold in reserve for the periods of time where your immediate renewable generation isn't filling the gap. There is clearly a huge amount of regional difference, and that will all come down to the actual energy mix, depending on whether you're more reliant on wind or solar or other generation types. But the country by country approach has to be the way. And I think that certain parts of the world, particularly, you know, Europe, the US, where there's quite a lot of structure, the repurposing opportunity is clear, and perhaps allows hydrogen to become a component of the energy mix in a quicker way. Whereas in other parts of the world where there isn't such existing infrastructure, the approach would have to be different. And I think that case by case basis is essential, but I don't think any of these technologies should be discounted simply because they don't have a prominent role today. I think they all will fill part of the solution, and it just needs to be approached in a sort of systematic, localized way to adopt them as necessary.
Thank you so much, Hassan. Dave, I was going to ask you the next question as to why does the brief recommend workshops on a regional basis, but I think Michael and Hassan did a pretty good job of responding to that. So the last question goes to you, and this is, what is the importance of timing, both in terms of building a plan and in terms of the transition itself?
Yeah, great question. So there's really two pieces to timing. So one is timing of the transition, and the second part of it is timing of the until the transition starts. So transitions from a time until transition, the longer the time that you have, the more options that you have. The more options you have, you can investigate what will be the least disruptive and the most fluid for actually managing your infrastructure appropriately, your energy infrastructure appropriately. And then there's the timing of the actual transition. The funny thing is, in the media, it often seems like people believe the traditional energy sources can be flicked off with a light switch and then the new one starts flicking on, and it's a very seamless piece. And there's no concern about baseload or any of the rest of that. And that's so crazy, because really the path of the future is we're trying to take an energy transition, which normally in the past has happened over centuries, cramming it down into a couple of decades. And we have to try and manage all of this billions to trillions of dollars worth of energy infrastructure. What needs to be decommissioned? That takes time. How much money is going to take to decommission it? That takes time to gather that much money and plan for that in the future. And what can be repurposed? Careful thought needs to be put into that. All of these things need to be decided before the transition happens. Now, of course, obviously part of the world, this is already going on. The transition is already in play. And so that reduces the amount of time. And so the time of actually going through the transition, switching from one energy source to the other energy source, because we're trying to do it in such a condensed fashion, we need to be very mindful of what are the pieces that of infrastructure that can be repurposed? What are the pieces of legislation that needs to be in place and policies so we have maximum efficiency and effectiveness? And we need to have plans on regional basis, because oftentimes with regions, they have shared infrastructure. The decline of traditional resources like oil deposits and gas deposits start to mature at the same time. Shared policy can make these things more efficient and help us navigate the timing piece as efficiently as possible, both in terms of now until transition or during the transition process.
Thank you so much. So we're almost out of time, and I want to thank all four guest experts for coming on and making themselves available for questions. I do have one more poll question, so please don't leave. The last poll question is this: do you think an infrastructure action plan is needed to effectively plan transitions? Yes or no? So I'll give you a few seconds to respond to that, but please do. In the meantime, I do want to say that the council is currently working with Colombia to organize a workshop in Latin America to discuss an infrastructure action plan for that region. And Dave and I will be happy to travel to any other place to talk about this, the need for an action plan. For this session, we're going to take the recording, put it on our YouTube channel. As surprisingly as you may be shocked, the last time we did this for hydrogen, over 300 people actually watched most of the webinar on YouTube. So we'll put it on there and get more information and insights from them. Okay, so I think that brings us to an end. Thank you so much for answering all the questions, and thank you so much for our guest experts for being here and making yourselves available. With that, I will end the webinar, and thank you, everybody.
Thank you. Take care.
Thank you.
Thanks all.